Welcome, everyone. We will have today's seamless webinar with Martin Evans, who is a professor of economics in Georgetown's Department of Economics. Previously, he held faculty positions in the McDonough School of Business at Georgetown University and at the New York University Stern School of Business. He has also been a faculty member at the University of Michigan, the London School of Economics, and the Wharton School at the University of Pennsylvania, as well as a visiting scholar at the Bank of England, Princeton University, and the International Monetary Fund. Professor Evans' main areas of expertise is international finance, particularly the behavior of foreign exchange markets. Much of this research is covered in his graduate level textbook published by Princeton University Press called Exchange Rate Dynamics. And the main feature that distinguishes his research from earlier work on exchange rates is its foundations in trading activity. This micro-based approach yields new insights into the forces driving exchange rates, insights that are strongly supported by the data. It also has far-reaching implications for international investors, currency risk management, and central banks. And this research has been published in a large number of leading academic journals and has been the subject of articles in The Economist and other financial publications. Professor Evans' research also contributes to the literature of applied macroeconomics, international finance, and asset pricing, and his paper in these different areas are listed in publication in his website. So if you want to look at them, you can read them. You have the link to his webpage in the seminar's webpage. Professor Evans has also provided expert advice on macroeconomics, finance, and international policy to central banks, consulting firms, and international corporations. So as a disclosure, I'm reading this from his biography on his webpage. I didn't write it, just given what has been happening recently in the Republican convention. So this was not written by me; it was written by him, but it describes pretty well the great scope of the work that the speaker that we are receiving today has done. So thank you very much, Professor Martin Evans, for sharing this presentation with us.
Okay, well, thank you for the introduction. Welcome, everybody. So first of all, I must tell you all that this is the first time I have attempted to present in this type of venue. So if I make some rookie mistakes in terms of using the system, please bear with me. So today I'm going to talk about some joint work with Dagfinn Reem, who is at the business school in Oslo, Norway. And as you can see from the slides here, this is a paper about exchange rates, interest rates, and the carry trade. And you can download the paper, I think, at the link given to you in the chat box. So without further ado, let me give you an overview of what the paper aims to do and how we go about doing it. So the aim is really very straightforward. What we're attempting to do in this paper is to identify the impact of the carry trade on currency movements. So it's a very simple, straightforward aim. And to do this, we undertake basically 4 steps. So the first step is we're going to identify what a carry trade portfolio would be for a representative hedge fund, which we're going to situate in the United States. So that's a sort of a straightforward portfolio allocation problem, and it's going to exploit the predictable variations in excess returns on foreign currency denominated bonds. So it exploits deviations, predictable deviations from uncovered interest parity, and it's a very sort of simple version of the carry trade. So having estimated this carry trade portfolio, we are then going to think about its implications for the actual trades the hedge fund would make in currency markets. So if you think about this, we have positions of the portfolio each period, and then to achieve these positions, the hedge fund would have to trade. So we translate the portfolio positions into what the trades would be. And then in the third step, and here's where we start coming to the data, we're going to match actual flows of trades in 12 spot currency markets against the predictions of the model. And so what this does is it takes each flow of trades for a particular currency pair and it breaks it up into two bits. The first bit is what we would attribute, according to our model, from the hedge fund following the carry trade. And then the rest is whatever else is driving trading in the spot exchange market. And we do this for all the flows across all 12 currency pairs. And then what this will get out of doing this is we can then identify how much wealth our representative hedge fund has in the carry trade at each point in time. And we can figure out as well what their positions were in each of the currencies. And we can work out what their trades were to support those positions. So that's step 3. And just to sort of take a step away, back, if you like, for a moment. So what we've really done here is, in the first 3 steps, we come up with estimates of the trades that would be needed to support a carry trade strategy, one which is implemented across 12 currency pairs. And the strategy is exploiting the predictable deviations from uncovered interest parity. So the output we like from step 3 is we've now got these trading flows in each of the currency pairs that are driven by the carry trade. And then we can get to addressing the question in the paper, which is to examine what these flows actually do on spot rates and interest differentials. So this is sort of the novel bit of the paper, in that we are trying to directly identify whether large flows of orders in particular spot markets driven by the carry trade are actually behind large movements in spot exchange rates. And why are we interested in that? Well, when people talk about exchange rate movements, there are lots of instances where there are big spot rate movements, but it's unclear that really anything in terms of macroeconomics really has changed. So people are left sort of grasping for an explanation for why the exchange rate moves so much. And they often resort to saying, well, it's because there was a big carry trade unwinding. In other words, there was a lot of trading activity associated with people engaged in the carry trade changing their portfolio positions. Now, what we're doing really in this paper is investigating whether we can see any evidence of that when we have estimates of what those carry trade flows should be. And that's really what we're about in the paper. So what do we find? Well, somewhat surprisingly, we find that our carry components of the flows we see in these spot exchange rates don't have a big effect on the actual rates themselves. So contrary to sort of the assumption that's frequently out there that when there's a big movement in an exchange rate and there's no obvious change in interest rates or anything else, that it's due to the carry trade, we can't find any significant evidence of that across our across the currencies we study. So we just don't find that flows into or out of currencies motivated by the carry trade are responsible for some of the previously unexplained movements in exchange rates. So that's the first result, which is sort of a negative result. The second result is that the flows that we identify as being associated with the carry trade affect interest differentials instead. And then, as I will argue, if you think about this for a moment, there's no real reason why the flows driven by the carry trade should only affect exchange rates. In principle, what they're doing is they are shifting desired portfolio allocations, not only in the currency markets, but also in the underlying assets that are being used for the carry trade, in this case, the bond markets. And so it's perfectly sensible to think that the carry trades could materially affect the interest rates on those bonds rather than just the spot exchange rates. And what we find is that that seems to be the case. Not across every currency pair, but across a good deal of them, the flows that we identify as being driven by the carry trade do have a materially large effect on the interest differentials. So the bottom line is not that the carry trade has no impact. It just doesn't have the impact where we thought it would be. It doesn't appear to be in the spot exchange rate dynamics. It appears instead to be in the interest differentials. So that's a little bit of a surprising result, but we'll dig into that, why that's the case. Now, as a way to think about this, and this isn't in the paper, but is an example from my textbook, which gives us an idea about what's going on and why we get this result. So in this example, and let me see if I can use the pointer here. Okay, that move it. I don't know whether people can see. Ah, there we go. Okay, here's the pointer. Whoops. So in panel A, what we have here is just the yen-dollar spot exchange rate in 1997 through 1998. And as you can see, there is this run up and then sudden decline around the end around September, okay? And this movement in dollar yen was often attributed by commentators at the time as due to the unwinding of the carry trade. So this is the type of movement that people often think of as being driven by the carry trade. And so the question is, well, can we see any evidence to support that claim? Well, in the next three panels, what we have are the flows going into the dollar yen spot market via Citibank across three different types or classes of the bank's customers. So corporate flows, that's in B, unlevered investor flows, that's in C, and in D are the levered investor flows. And in each of those three panels, you'll see that the black line is the spot rate. So now what we're doing is we're blowing up the scale so you can see what happens day by day. And then the blue dash line is the flow from that group that's actually coming in from Asia, and the brown line is that flow that's coming in from the United States. So what I want you to notice here is, first of all, if we look at the corporate bond flows, excuse me, we can see that they are going in the opposite direction to the spot rate. Okay, so the corporate bond clients of Citibank were accumulating positions. The flows are positive, and they are positive around the point at which there's this big fall in the spot rate, in the black line. Okay. If we now look at down here in D, we look at the levered investor flows, we can see that there they were negative, but they were negative, well, they were falling, we should say, some time before the actual spot rate moved. Okay, so these are in days here, and you can see that the levered investors were changing their position with this falling down some time before the spot rate moved. So if we were to look in the day that the spot rate moved a lot, we wouldn't have seen a lot of action by the levered investors. Now, as a group, this is where we would expect to see the carry traders being sitting. Okay, but as you see, that it's just not there. If we look finally at the unlevered investor flows, you can see, well, here there is a more complicated picture. First of all, the US flows do nothing at all, and the Asian flows, yes, they're gradually coming down, but again, there isn't a strong coincidence between the flow and the big exchange rate movement. So what does this picture tell us? Well, it tells us that if we were just looking at the time immediately around the large currency movement, we don't see that there was associated with that large currency movement a big change in the flows associated with Citibank's customers. Now, Citibank being a very large bank, meaning this is sort of representative of what we would expect to see over the market. So in other words, even though we're looking at an example which is often attributed to the unwinding of the carry trade, when we look at the actual flows of transactions going into Citibank, we do not see coincident large flows that support that argument. Okay, yes, the levered investors do have negative flows, but they occurred some time before it was actually realized in the spot rate. And so if we were just to focus on the days when the spot rate actually moved a lot and looked at the leveraged investor flows, we wouldn't see anything there. So there's something more complicated going on. Okay, and to some extent that's what this paper is about, is trying to figure out, well, what exactly is going on. And so let's now turn to that. Okay, so just before we get into the details of the paper, let me just put this in the context of a larger literature. So first of all, the carry trade really refers to a big class of trading strategies that the common feature of which is that they're exploiting predictable cross-country differences in returns. And you can execute such strategies in lots of different financial assets. You can use currency derivatives, you can use equities, you can use foreign currency loans, you can even use the international banking system. And on the slide here are some papers that have talked about that. There's also a very large literature which looks at the returns you get from various carry strategies. So people are examining the predictability of return differentials and trying to figure out what might be driving them. Now, what we're doing in this paper is more closely aligned with this sort of third group down here, which tries to look at measures of carry activity. Now, here the literature has much less to show us. There are some papers that try to look at measures of carry activity by looking at futures positions. And there's another branch to try to look at banks' balance sheets. And as people working both of those literature are quite upfront about, I mean, these are imperfect measures of the actual carry positions. And so there's always a sort of a measurement error problem in trying to figure out, well, do these changes in activity or the flows associated with them do anything in terms of exchange rates or any other asset price? There's also a lot of literature looking at sort of the indirect evidence of the effects of the carry trade. So one paper that's often cited is by Brunemeyer and co-authors, where they look at the empirical link between interest differentials and the skewness in the distribution of exchange rate returns. And they interpret what they see there as consistent with the carry trade. But this, of course, is indirect rather than direct evidence of a carry trade, because there is no data on what the carry trade was doing, whether it actually lies behind this or not, or there's something else at work. There's also a literature on hedge fund returns, which again is looking indirectly at the carry trade insofar as hedge funds are following carry trade strategies. But again, that gets very difficult to figure out exactly what's going on, because the hedge funds obviously are not particularly transparent as to the exact trading strategies they're following. And so there's always a question about whether the hedge fund returns that you're looking at represent returns on a carry trade or some combination of the carry trade and something else, or something different entirely. So in this paper, relative to the literature, what we're doing is we're identifying the trading patterns necessary to support a carry trade. And then we're looking at how important those trades are empirically by matching them against aggregate trading data in the spot foreign exchange market. And then the third step is we look at the effects of these estimated carry trades on the spot rates and interest differentials. So I probably should have looked at the chat window here. So maybe I should sort of explain how the model works, and then things will become sort of clearer to those of you who have questions. So the model here is quite straightforward. So what we're going to do is we're going to think about a portfolio allocation problem that exploits predictable patterns in the excess returns on holding foreign currency bonds. And so to set things up, let's think about a prototypical hedge fund that has a portfolio of N foreign currency bonds and US bonds. And their portfolio return is given by this first equation here. So R0 is the return on US bonds, Ri are the returns in foreign currency on the foreign bonds, and then S is the spot exchange rate for the various currencies. And so we can just rewrite that portfolio returns in terms of the US return and then the excess returns. Those are the ERIs on the N foreign currency portfolios. There they are. So once we've written portfolio returns like that, we can further write them as I have in equation 1, where this lambda term is going to be the share of the total portfolio in the N risky assets, and the alpha is a vector of the shares of the individual bonds amongst the risky assets. So this is all definitional at the moment. Now we're going to actually define how the portfolio is chosen. So the risky portfolio's shares are chosen to maximize the conditional Sharpe ratio, which is in equation 2. So the way the model works is we're going to have estimates of the conditional expected return on the portfolio and its variance. And we are going to, given those expectations and the variance, we're going to solve this portfolio allocation problems for the optimal shares in the risky bonds. Okay. So now once we have that, we're then going to think about the implications of that portfolio decision for the trading decisions of the hedge fund. So delta xi here is the order flow into currency I consistent with the portfolio decisions of the hedge fund. It's just the difference between the desired holdings today and your previous holdings. So your desired holdings today are this first term, and the current value with the capital gain and loss from the previous period is those your existing holdings. Okay, so you trade to get to your desired holdings, and then we can just rewrite those terms as we do down here into equation 3 in terms of the risky asset shares, the alpha i's, and then this lambda and the A. The A is the total amount of wealth, so the lambda A is actually the amount of wealth in the risky assets, and this gamma I is constructed from the capital gains and prior portfolio shares. So this gives us what the trades would be for each currency. And of course, we can look at them across all the currencies. This is all done in dollars. Okay, so these are the dollar flows for each of the currencies, just by aggregating up across them all, which is down in equation 4. So what we're doing here is we're taking the implications of the portfolio model and translating it into the order flows for each of the currencies. Okay, so now let's turn to how we're going to estimate all of this. So the first thing we need here is estimates of the expected excess returns and their variance, from which we're going to use in the portfolio allocation problem. So we do that first of all by estimating a system of equations, which is given in equation 6 here for each of the currencies. So S is the spot rate, F is the forward rate, so the left-hand side is the excess return, and consistent with the large literature on uncovered interest parity, we're going to use the forward premium as the right-hand side variable, which of course under covered interest parity is just the interest differential. So we're forecasting excess returns based on interest differentials. We're going to do it for all of the currencies, but we're also going to do it as a system. So this is a seemingly unrelated regression system. And we're going to do it recursively in real time. So the idea here is we take the first, let's say, 100 observations in the data. We estimate the system. We get the estimates of the coefficients. We then use those estimates to forecast the expected excess returns on each of the currency pairs in the 101th observation. So we're doing outer sample forecasting. That gives us the expected excess returns. We also compute the variance of those things. And those go into the portfolio share problem, which is equation 7, from which we compute the optimal portfolio shares. So what we're doing here is we're estimating the optimal portfolio shares in sort of real time, as you could have done at the time. So we're only looking at data that was available at the time. So that gives us the risky portfolio shares. And then what we need to do is we need to estimate what fraction of the order flow we see in the data that can be attributed to those portfolio shares. So this is a little more complicated. So in step 3 here, I have the order flow for a particular currency relative to the US dollar. Okay, so that's data. I'll tell you about the source of that a little later on. And then we're splitting that into 2 bits. The first bit is the order flow that comes from the portfolio problem. That's the first term on the right-hand side. And the second is everything else that's driving order flow, okay, unrelated to the carry trade. So when what we do is we break down the order flow from the carry trade into its constituent components, which is all the way down to equation 8. Okay. So now what we have is an equation that relates order flow in the data to the alpha i's, which we've solved for optimally, and the lambda and a's, which is the wealth in the carry trade. Now, this equation has to hold across all of the currency pairs we're considering. In fact, it has to hold for the 12 we're going to consider. So what we actually do is we use our estimates of the alpha to solve the problem in equation 9. So what we're now doing is we are figuring out what the wealth in the carry trade had to have been to explain as much as possible of the order flows across the 12 currency pairs. And that's the minimization problem given in equation 9. And the phi's here are really weights we're attributing to the individual currencies, because we want to experiment with putting different weights on the different flows. But I can talk about that later on. That's an unimportant detail for the moment. So equation 9 is the problem we solve to find the amount of wealth in the carry trade at each point in time using the data we have on order flows and the optimal portfolio shares. And once we've done that, we can estimate the carry trade flows. So now let me talk about the data here. So we're going to look at weekly data from 97 through 2011. We're going to look across 12 currencies. There are the currency pairs. We're looking at data at the weekly frequency, and we're going to use as the spot rates, the WMR fixed rates. We're also going to use data on interest rates from euro currency deposit rates. And then we're also going to use the order flows we can compute from the Reuters limit order book. So for those of you that aren't so familiar with all the details of forex trading, Reuters limit order book is one of the two principal venues for interbank trading in the foreign exchange market. And what we do is we take the second by second data from that order book and aggregate up to the flows of orders in each of the currency pairs at the weekly frequency. So that gives us our data on order flow. So just to give you an idea of what that order flow data looks like, so here for all of the currency pairs we consider, you can see there's lots and lots of variation in the flows over the weeks in our sample, both in terms of the standard deviation, and then we've got the percentiles of the empirical distribution here. There's lots and lots of fluctuation. There isn't much serial correlation. That's the right-hand column here, which is, of course, not that surprising. But that's what the raw flow data look like. Okay, so now let's think about our portfolio model. So the first step empirically is we're estimating this system of regressions recursively, and then from that we are each period computing the outer sample forecast for excess returns, their variance. We're solving the portfolio problem, okay, and then we're going to take those on to the next step. So first of all, under panel A here and column 1, I'm showing you the estimated slope coefficients from the regression estimated in the full sample. And the thing I want to point out here is the negative coefficients, which of course are familiar to people from uncovered interest parity literature, which sort of basically shows, yes, there are these predictable deviations from uncovered interest parity. And these are what, of course, are driving the whole notion that there's a carry trade that could be profitable. But these, are, of course, are the coefficients that are estimated over the full sample. And you couldn't have estimated those in real time. You wouldn't have had the data. So then the next three columns, 3 through 5, show you the percentiles of the distribution of the coefficients estimated in real time. And the thing I want you to notice here is that there's lots of variation. Yes, they are predominantly negative, but there are times when they're extremely negative, other times when they're only moderately negative. And of course, it is this time variation that we're going to be picking up when we're doing the portfolio optimization. So that's panel A. Panel B then gives you an idea about what the optimal portfolio shares are. So the first column here shows you the average over the whole sample period of the portfolio shares. And you can see there are some large positive numbers and some negative numbers, not so many negative ones. Negative ones mean, of course, you are actually borrowing in that currency. That's a funding currency in terms of carry trade terminology. And the positive numbers mean that that's where you're investing. But that average really doesn't do justice to what's really going on, because if you look in the right-hand three columns, you see the distribution percentiles for the shares estimated in real time. And you can see there's lots of variation. So what's happening is that because the degree to which you can forecast future excess returns in real time is changing over this sample period, so too are the optimal portfolio shares. And so the carry trade strategy that's actually being implied by these real-time forecasting results is one in which you are changing your shares of your risky portfolio in different bonds quite considerably. So to give you some picture about the degree to which we have variations in expected excess returns, here we have them for Australian dollar, Canadian dollar, Swiss franc, and you can see they're moving around a lot. And a second set of picture here we are for the euro, pound, and yen. So these forecasting regressions are picking up lots of variation, predictable variation in excess returns. And so, there is lots of potential here for engaging in the carry trade. So that's sort of the driver of what's going on in our portfolio problem. So what do the actual risky portfolio shares look like? Well, here they are, the average in the left-hand column, their percentiles in the middle, and then on the right-hand column we have what the shares would be if you just estimated the forecast over the whole sample and solved the portfolio problem once. So sort of the unconditional portfolio problem. And the point here is that the shares you would choose unconditionally, ignoring how things change over the sample, are quite different from what you're actually holding on average even. And of course, at individual weeks, you're holding positions which are very, very different. Notice as well, if we look at the percentiles for any particular currency you like. So for example, let's look at the New Zealand dollar. You see down here, if I can move it, okay, it ranges from -0.7. That's be a situation where the New Zealand dollar is actually using as a funding currency, to one where it's 2, where it's being an investing currency. And you see that for a lot of these currency pairs. There's lots of variation. So Another measure of how this portfolio allocation problem works is to look at the Sharpe ratio of the strategy, which is with the changing portfolio shares relative to what would have happened if we just stuck the unconditional shares in there that weren't changing. So that's the blue line, and as you can see, the Sharpe ratio is quite a way below 1. The red line is the Sharpe ratio we get from following this actual strategy. So you can see that there is a significant benefit to allowing the portfolio shares to change in real time as the degree of predictability in excess returns changes through time. Another measure of how well this portfolio problem does is just to look at the cumulative returns. And here again, the cumulative returns on this strategy over the sample are given in red. The unconditional, the cumulative return on an unconditional strategy, i.e. you just fix the shares at their at a constant value consistent with the unconditional risky shares, which you couldn't really have done, but just to give you an idea of how much difference it made. You see that's the blue. And interestingly, the blue does pretty well until you get to 2008. And then it starts to do pretty badly. So it's really from 2008 onwards do you see in this particular sample a big benefit ex post in changing the portfolio shares and incorporating the evolving forecastability of excess returns. Okay, so now let's look at what this portfolio problem implies for the carry trades. So here we're showing statistics on the carry trade that we can attribute, the order flow that we can attribute to the carry trade. So the left-hand column here shows you the mean carry trade attributable to the mean order flow attributed to the carry trade and its standard deviation and its autocorrelation. And then the right-hand column is showing you the rest of the carry trade. And what you will see here, first of all, is that in terms of the standard deviations, there's much more variation in the non-carry trade than the carry trade portion of the order flows. And the right-hand column also shows you that the non-carry and carry portions are strongly negatively correlated with each other, with the exception of the pound and maybe the Australian dollar. So now what do the estimates look like? So here is a plot that shows you the estimated wealth in the carry trade relative to the start of our sample. So what we're doing here, remember, is we're figuring out how much of wealth was invested in the carry trade consistent with the patterns of order flows across these 12 currency pairs. Okay? And so that's the red line, and the blue line is the cumulative position, again, relative to the start of the sample in the carry trade. So it's just accumulating up when there's more money going in or more money going out into the carry trade. And these things are obviously pretty close to each other. The difference comes later in the sample where you start accumulating sizable returns on what your accumulated position. What's interesting here is, of course, the big movements in 2003, 2004. So our estimates say that for whatever reason, there was a large fall in the amount of wealth in the carry trade, followed by a sharp reversal. The other interesting thing is to look at the large drop-off after 2008. Now, we would expect, given the financial crisis, to see, well, we would hope to see a drop off, and that's exactly what we see. But important here is that there's nothing in this methodology that guarantees that that would happen. And so the fact that it does gives us a little bit of confidence that this methodology is picking up something that makes economic sense. What about the portfolio returns? Well, here we have in the blue the expected return on the portfolio. This is a moving average to get rid of the high frequency stuff. And then in the red, we have the order flow. This is the aggregate order flow going into the carry trade. And you can see that, when the carry trade portfolio is doing well, order flow is going in, and when it's doing badly, it's coming up, which is, of course, exactly what you would expect. Okay, so we've now got some estimates of the carry trade component in the order flows for each of our 12 currency pairs. We're now going to look at what those flows do. Remember, the conventional wisdom is that if we see big carry trade flows, we should see big spot rate movements. That is the notion of when there's a big unexplained movement in spot rates, it's attributable to a carry trade. So to analyze this, we're going to do something very, very standard. We're going to look at some VARs. So it's a so-called structural VAR where we have 4 variables. We have our carry trade component of order flow. So we're doing this VAR is estimated for each of the currency pairs. So the first variable is the carry trade order flow. Then we have the total order flow. So it's got the carry trade component and the other component. The third variable is the first difference of the log interest differential between the foreign country and the United States. And then the fourth variable is the first difference of the log spot rate. So that is the depreciation rate. And remember that the time interval here is a week. So the bottom here is the weekly depreciation rate. We have the weekly first difference in the log interest differential, weekly order flows, and the weekly carry trade flow. And then we are going to use some short and long run restrictions to identify things. So the short run restrictions are in equation 12. And just to point out, so we don't quite have the lower diagonal usual setup here. We have this additional term, non-zero term. So that is picking up the fact that a shock to the interest differential can contribute to the carry trade order flow. We allow for that. It's sensible to allow for that. So carry trade order flow basically is driven by its own shock and shocks to the interest differential. Then all the order flows are driven by the carry trade and their own shock, the interest differential by the carry trade, all flows and their own shock, and then the exchange rate by all of the shocks. And what we're really interested, of course, is this coefficient down here, the theta 4,1. This is the coefficient that tells us how does a shock to the carry trade flow affect the depreciation rate. The second expression down here shows you the restrictions we put on the long run impact necessary to identify things. And we put in 1, 0 long run restriction here. And that is that the shocks to order flow have no long run effect on the level of interest differentials. And that makes economic sense if you think that in the long run, it's monetary policy and central banks' monetary policy that are pinning down the levels of interest rates. It's got nothing to do with, flows in the currency markets. So we impose that long run restriction to identify everything. Okay, so what do we get when we estimate things? So here, this is showing you the coefficients from the short run impact of various shocks. So first of all, in the left-hand panel here, we're looking at the effects of shocks on the carry trade. And if you look at the second column, what you see here is that in 4 of the cases I'm showing here, which I'm not showing you all of the results for all 12 currencies, but these are representative, you see that there are significant coefficients indicating that shocks to interest differentials are affecting the carry trade, which makes economic sense. Okay, we would expect if there's an unexpected variation in monetary policy, that could trigger a change in the portfolio positions of people engaged in the carry trade, which in turn leads to a carry trade flow. The second group here is showing you the shocks to order flow. Yes, everything's significant there, not particularly interesting. The third gets more interesting in that now we're looking at what affects the interest differentials. And what we see here is that in this first column, the theta 3-1, we see that with the exception of the euro dollar interest differential, shocks to the carry trade are significantly affecting these interest differentials. Okay, so do the aggregate order flows. Okay, and then finally we get to sort of the first punchline of the paper empirically, which is to look at the effects of the carry trade shocks on the depreciation rate. And what we see here is that yes, in a few of these currencies, so the Canadian dollar, the euro, the pound, there are some statistically significant coefficients. So there is some evidence of a carry trade effect, okay, but it is not uniform. And so then the question is, okay, how big is this effect? We're looking at this, of course, at this is the impact effect, so we're only looking over a 1-week horizon. So we want to think about how large are these effects over longer horizons, and so on. So to look at longer horizon effects, let's first of all consider the interest differential. So these are variance decompositions for the interest differential across a subset of the currencies. And what we're looking for here is the role of carry trade shocks. So for example, let's look at the Australian dollar. So we're looking at this left-hand column. And what we see here as the horizon lengthens, the variance contribution of the carry trade shocks rises up. At 26 weeks, it's around about the same contribution as the interest differential shocks themselves. And notice that this pattern is repeated across any number of these currencies. So we see it for Canadian dollar, we see it for the Swiss franc, we see it for the New Zealand dollar. In fact, in the New Zealand dollar case, you can see that the lion's share of the variance is coming from the carry trade shocks. Exception here is the Norwegian krona. There it does nothing at all. For the Mexican peso, we see it's sort of 50-50. It's contributing about 50% of the variance. So this is the first evidence that the carry trade, shocks to the carry trade flows are having a material impact on interest differentials. Now what about the spot rates? Well, again, we want to look at the left-hand columns in each of these blocks. That's showing the variance contributions of the shocks to the carry trade to the variance of the spot rates at various horizons. And notice now what you see is these numbers in the left-hand column are uniformly really small. Okay, they are really just a few percent. By contrast, if we look at the Australian dollar, we see that all the order flows are making a significant contribution. Same for the Canadian dollar. Okay. But across all of these currency pairs, we see that the shocks to the carry trade themselves just aren't contributing much to the variance of the depreciation rate. So that's the first, material evidence saying that carry trade shocks here just aren't doing much in terms of driving spot rate dynamics across lots of these currencies. Now, of course, these results are sort of summarizing up what's going on over the whole sample. So to supplement them, what we can do is now think about whether there are episodes in which the carry trade was much, much more important. So to do this, what we're going to do is do historical decompositions of the variables in the VAR and look at whether those identify any periods where the carry trade had a particularly large effect. So the first point to look at here is to look at the carry trade order flows themselves. So what we're looking at here is the cumulated order flow we identify as being driven by the carry trade. So the actual flow itself is the red line. So let's just look down here. These plots are probably a little hard to see, but I hope still intelligible. So let's look down at the pound. So the red line, the red plot here is the cumulated flow driven by the carry trade. And what I want you to notice is there's a big swing in this sample period. And if you look at the other currencies, you will see same for the Swiss franc, same for the euro. So over this sample, there are big swings in the carry trades, what we identify as the carry trades. Okay. Now the other lines show you the contribution of different shocks to those. So for example, if we look at the blue line, that is showing you the contribution that's driven purely by shocks to the carry trade. If we look at the purple line, we see that is the contribution of shocks to the interest differential in just one of the currencies. So if we look, for example, over in the Japanese yen case, you can see there's very, very little difference between the purple line and the red line. What that tells you is that the cumulated carry trade flows for dollar yen are basically attributable to changes in the interest differential between yen and dollar interest rates. Okay. Whereas if we were looking at the, let's say, euro dollar rate, you can see here that the purple line explains very, very little of the big swings in the red plot. Okay, so the carry trade flows we identified in the euro dollar spot market, yes, they have some swings, but they're not being driven by variations or shocks to US versus European interest rates. So then you ask, well, why do you see the swings? And the answer is you're seeing the swings because there are changing expectations about the excess returns on the other 11 currency pairs in this hedge fund's portfolio problem, and the hedge fund is adjusting their allocations across all the currency pairs. And so what we see when we look at the euro dollar is, yes, big carry trade flows, but they're being driven as part of a multi-currency carry trade. It's a more complicated picture than just thinking about the carry trade on a currency pair by currency pair basis. So the important point to take away from these set of plots is there are big movements in the cumulated carry trade flows. So now let's look at the exchange rate decompositions. So again, these are for these four currencies. You can look at others in the paper. and the actual paths are again given in red. Okay, so what we're interested in looking for here is when we compare the red plots with the blue plots, do we see any periods where they sort of line up? So now the blue plot here is what we estimate to be the contribution of the carry trade flows to the spot rate during the sample period. So let's take the Swiss franc as an example. So we look in this case, and you look around 2007, 2008, there are some movements in the actual rate, the red plot, that are reasonably closely mirrored by the blue plot. So there is this small subsample of the data where it looks as though some movements in the Swiss dollar rate were associated with the carry trade. But if you look over the whole sample, you see that that's really the exception. Similarly, if you look for the euro, you see that the blue line is essentially flat. And again, if you look for the pound, the blue line is essentially flat. And if you look for the yen, the blue line is essentially flat. So what these plots show is that even though there are sizable carry trade flows, they're just not contributing to the historical movements in any of these spot rates over anything more than a few little snapshots. So overall, they just don't do that much. So what about the interest differentials? So if we look here, we see again the actual interest differential paths, those are the red, and then we see the contribution to the carry trades to the blue. And here you see a somewhat different pattern. So let's look, for example, at the yen down in the lower right left. Here you can see that the blue plot closely, but not exactly, mirrors the actual interest differentials. So here we are seeing that the carry trades we identify in the dollar yen are materially affecting the interest differentials over the sample period. And it happens throughout the sample period. Okay. If we look at some of these other currencies, the pattern is less clear-cut. For example, in the pound's case, there are some periods where if we look, say, for between 2004 and 2006, you can see that the actual path of the interest differential is closely mirroring that implied by one driven purely by the carry trade. But then there are other portions where there's no close association. And similarly for the Swiss franc. So what we see for the interest differentials, in contrast to the exchange rates, is that there are significant portions of the sample where the interest differentials appear to mirror the path implied by just the effects of the carry trade. There are other periods where that's not the case, but the periods where this mirroring takes place are much, much longer and more frequent and more substantial than anything we see in the exchange rates. So we get to the bottom line, which is we can't find, somewhat to our surprise, any concrete evidence to support this widely held notion that large movements in spot rates that appear unexplained by sort of macroeconomic news, changes in monetary policy, other things that we can identify, can be attributed to flows originating from the carry trade in a model where we have identified those flows in a manner consistent with exploiting UIP deviations on a cross-currency basis. We just don't find any evidence of that being true. On the other hand, And again, somewhat surprisingly, we do see that these flows we identify as being attributable to this carry trade do seem to have a statistically strong link to interest differentials over this sample, at least for some currencies. It's not uniform, but at least for some currencies, and in some time periods, that these associations seem to be very strong. Now, of course, this model doesn't allow us to investigate this second point. We can only conjecture about what's really going on there, because we don't have an economic model that is explicitly linking flows in spot currency markets to the behavior of interest differentials. It's purely a statistical model. We were initially just looking for effects in the currency markets. So this leaves open, the second result leaves open the question of exactly why is it that the flows we are identifying as being associated with the carry trade are having such a strong statistical linkage to some of these interest differentials when they appear to have so little impact on the spot rates. So that at that point, I think, you know, and I probably have been remiss in not paying enough attention to the chat, but now will be probably a good time to entertain people's questions.
Martin, I switched the view. Perhaps that way it is easier to read at the chat window. But if at any time you need me to come back to the presentation,
so you want?
Let me know. Well, there are some questions there on the chat window and some comments.
Okay, so yes, there's this question here about so this last question, how does this relate to Verdelhan's work on the what he calls the carry factors? So it's important to draw a distinction between what we're doing in this paper and what people talk about as the carry trade elsewhere. So in Verdelhan's work and other people, what they call the carry trade is simply an interest or an excess return. So that they basically say, okay, let's look at trying to explain excess currency returns in terms of interest differentials. So it's like it's like the regression I use in the portfolio problem. That work does not attempt to identify what the actual flows or the trades would necessarily be to support a carry trade that exploited the predictability and excess returns. So when somebody says they're saying something is due to the carry trade, they're not really saying that they have evidence that there is a statistical link between predictable excess returns based on interest differentials to trading positions that exploit them, to order flows in currency markets, to exchange rate effects. All they have is a statistical link between an interest differential and excess return. And what accounts for that statistical link, there's no structural model. So you could call it a carry factor, but that's simply a name. So what we're doing here is we are trying to look for empirical evidence to support that linkage from forecastability of excess returns based on interest differentials to a portfolio position, to trades that support it, to the effects of those trades in currency markets. So we're actually trying to look at the mechanism through which this would actually work. And the surprising thing is that we can't find evidence of that mechanism working in the way we thought it would work. We expected there to be periods in which unwinding of the carry trade produces large order flows in spot markets that produced large, previously unexplained movements in spot rates. Well, our model does produce large movements in the carry trade order flows, but they just don't correspond to large movements in spot rates. So there's no statistical evidence to support what people have sort of believed. On the other hand, we do find evidence that it shows up in the interest differentials. So these results are not inconsistent with a larger literature which relates excess returns to interest differentials. What we're trying to do here is dive beneath those statistical relationships that people have identified and try and think about whether there's statistical evidence for the underlying mechanism, and does it involve the unwinding or the establishment of large carry trade positions and their effects on flows and their effects on exchange rates. So it's complementary, I think, is the way to think about this work relative to what people have talked about in terms of the carry trade. They're doing this at a sort of a very reduced form level. They're calling it a carry trade, but unless you have data on the actual trading positions, you don't know whether it's a carry trade or anything else. So I'm just working back through the questions here. So there are a bunch of questions here about, I guess, about the portfolio the portfolio problem. So there are often questions here about the way that we have formulated the portfolio problem. There is no one characterization of a carry trade. There are so many different variants. So no model can expect to accurately represent all forms of the carry trade that exist out in the world. There are lots of people following strategies they call carry trades that do all sorts of very different things in different instruments. What we're trying to do is define a set of trades consistent with a generally accepted view of what's sort of the core of the carry trade. So in our model, we take the forecastable deviations in excess returns based on interest differentials as the foundation for our portfolio problem that our prototypical hedge fund then exploits. And we think that is the essence of all carry trades. Now, we're executing these trades in bonds. It could be executed in any number of other assets. But we're doing the simplest thing possible because we view this as the sort of the plain vanilla version of doing this. Now, you could argue that our portfolio problem doesn't exactly replicate what people executing carry trades in bonds actually do. And of course, that's exactly right. We could have thought about lots of different portfolio problems. We could have thought about one in which, we were much less sophisticated in allocating the portfolio across different foreign currency bonds. We could have used some sort of ranking, which other people have done. We decided to sort of do the full-blown portfolio optimization to sort of do as best as we could in terms of portfolio performance with this simple strategy in real time. And the proof of the pudding is, well, how well did it do? What were the Sharpe ratios? What were the realized returns? So the important thing here is we're not representing this as being an accurate representation of all carry trades. It's clearly not. It's representative of a carry trade. And then we're using that to identify components of flows. Now, if it were the case that our portfolio model was completely unrepresentative of what's going on in terms of actual carry trade strategies in the world, then what you would expect is that our estimates of the carry trade component in order flows were just noise. They didn't contain any economic information. And if that's the case, then we should find that our estimates of the carry trade flows do absolutely nothing. They should do nothing for interest rates. They should do nothing for exchange rates. They're just noise. Well, yeah, they don't do a lot for exchange rates, but they do a lot for some of these interest differentials. So even though we're not attempting to accurately represent what any one carry trade out there in the world is, our model, as a gross oversimplification of the variety of carry trades that actually exist, is still picking up something, because otherwise it's hard to understand why we get these strong statistical relationships between the carry trade component we estimate of the flows and the interest differential. If our model was just nonsense and there was nothing economic there, then there's no reason why we get these strong statistical results for the interest differentials. So the real puzzle here is not so much, okay, could we have a better model for the carry trade? Undoubtedly we could. This is a very simple model. But the question is, given the limitations of our model, why is it that we find these interest rate effects but no exchange rate effects? When our priors and lots of other people's priors going into this exercise is we should have found exchange rate effects if we find them anywhere, but we just don't do that. So let me just move back now to the some other questions here. So I think these other questions are, yes, along the lines of we're not capturing all the intricacies of how an actual hedge fund tries to execute any particular strategy. There are lots and lots of details we're missing out here. And so we fully recognize that, you know, if a hedge fund came along and said, okay, we're going to tell you exactly how we do things, and your model doesn't capture how we do that, the answer, our response will be, well, thanks for telling us how you exactly do things, and I'm not at all surprised that, you know, we don't capture it all in the model. We don't. The model is, again, a big, big simplification. What are the reasons for the apparent risk adjusted? Well, that's an interesting question. So what are the reasons for apparent risk-adjusted arbitrage opportunity in the carry trade? Well, I'm not sure exactly what you mean by risk-adjusted arbitrage, but I would interpret that to mean, okay, why is it that the returns on this strategy look as big as they are? So remember, this crude portfolio problem with this crude forecasting strategy produces this pretty impressive cumulative return over our sample period. So remember, we're executing a strategy here that you could have done in real time. Of course, we are not in these calculations figuring in, you know, the prices at which you could actually have executed large trades in and out of the position. So these returns are larger than you could have done in practice. We'll recognize that, but nevertheless, the returns are still quite large, and so the question now remains, you know, what do these account for? And that's basically an unanswered question. I think speaking more generally, I don't think there's a a consensus view on exactly why this should be the case. And it's a puzzle that's been around for a long time. So for the purposes of of our model, we're not really asking why is this stuff there, even though that's an interesting question. We're asking, well, given that it's there, what does it imply in the context of our model for the flows, and what do then those flows do? But of course, there is this larger question hanging out there of why can you forecast these excess returns quite as well as you can, and why does it appear that you can exploit them quite as well as you can? And that's a bigger question than we're really looking at.
So Carlos was typing perhaps another question or comment. I don't know if someone else would like to. There is one by Carolina
Yeah, no, I saw.
at the end.
Well, yes. I mean, I guess I could sort of agree with that. I mean, the methodology in identifying the carry trade component, we're trying to explain as much as possible of these flows across these 12 currencies to the carry trade as we can, to in some sense give it the best chance possible, and so to the extent that we're unsuccessful with these estimates in finding big exchange rate effects, sort of underlines how hard it is to find these exchange rate effects. To the extent that that there are exchange rate effects by the other components of the order flow, those are there in spades, but those do not appear to be driven by something that we can systematically link back to the carry trade, which is not what we expected. So yes, why is it more interest sensitivity than FX sensitivity? I mean, my working hypothesis on that is if we think as a crude approximation that the currency flows we attribute to the carry trade in some of these currency pairs are largely flowing into bond markets as a proportion of the flows into those bond markets. Those coming through the carry trade and from the spot markets are proportionally bigger, and so they're having a bigger price impact on the interest rates. In the currency markets themselves, there are just so many other factors that are driving the flows in the currency markets that the flows being driven by the carry trade are simply being swamped out. It's also important to remember that in the currency markets in real time, it's very hard for market participants to really know whether the flows that they can see or estimate are really being driven by people unwinding or establishing carry positions or something else. Very, very few people are in a position to even see a small slice of that activity. Even if even the banks. So the big difficulty in fact telling a detailed story about why carry trade flows would have a big spot exchange rate effect would require you to explain how suddenly everybody realized that the flow coming into the spot exchange market was dominated by carry traders and is all going in one direction, and therefore the exchange rate is going to move a long way. That just doesn't seem to happen in what we can identify. And interestingly, it did not happen in my Japanese example. So the interesting thing about the Japanese example is there's no model there at all. So contrary to what's in this paper, there we're looking at data from different classes of foreign exchange counterparties to Citibank. And so if we thought that, unwinding of the carry trade, triggered by hedge funds getting out of, a big speculative position, was the driver of that big yen dollar movement, you would have expected to have seen the flows coming from the levered investors counterparty to Citibank to have moved just before we see the big spot rate movement. Because you think, okay, it may have taken a little while for people to understand that's what the hedge funds had done, and they got out, and now everybody else was getting out, so to speak. But that's not what happened. The levered counterparties changed their position quite a few days before anything happened. So basically, they did it in secret, is a way to think about this. And nothing happened at all, which makes sense because they would try hard to do it in secret, and it would be very hard for many market participants to have much of an inkling about what's going on. So it seems that the story here that makes most sense is that the lack of transparency in forex trading makes it very, very hard for market participants in real time to identify that a lot of the flow is coming from the carry trade, and for that to become the driving force for the spot rate. So the simple notion that the spot rate is moving because there's this big flow being driven by unwinding of the carry trade is just much too much of a simple explanation. It doesn't seem to stand up when we start looking more closely at the data, either in the model of this paper or when we just look without a model at the flows from different customer segments. That story just doesn't seem to be holding together for whatever reason.
Any other question? If there are no other questions, I'd like to thank our speaker today, Martin Evans from Georgetown University, for this talk, and thank you for your comments and questions and attentions. Thank you to Carlos Barrera from Banco Central de Reserva de Perú and Carolina Pagliacci from the Banco Central de Venezuela for their questions. And in this series that we are conducting on exchange rates modeling and determination, we still have one more seminar to go that will be in September with Charles Engel. And please take a look at the seminar's webpage to get notices on when we have seminars. All of them are at the same time, noon U.S. Eastern Standard Time, through this same platform. Thank you very much, Martin, and thank you to all of you.
Yes, well, thank you for everybody for, I think it's the word attending or whatever, for logging on. And as I say, if I piqued your interest, please take a look at the paper. Actually, there will be a newer version appearing relatively soon on my website. So I'd encourage anybody that's interested in this line of work to take a look at that. That should appear in the next month or so.
Thank you.
Okay, thank you.